conversation going on the show and welcome our first guest. Sunil Tirumalai is the ED and India Strategist of UBS. He's here with us now to take some questions on where he really sees the market headed from here. Sunil, thanks a lot for joining us. This is Pavitra. Just on the markets and where we are right now, we've seen a significant correction in the valuations. I know that relatively it is still an expensive market compared to the rest of Asia. Is that what has you, still here with an underweight call on the Asian markets, that even after this correction, it is still, much more expensive?
Thank you, Pavitra, and good morning to all your viewers. Yes, so India has underperformed. So YTD, it's actually one of the weakest equities markets in emerging markets universe. But as you also pointed out, it still is expensive. It's still more expensive than usual. And I think for me, there were 2 or 3 reasons why we've been a bit cautious and underweight in the overall EM space. I think firstly, the earnings growth trajectory in India is normal. It's nothing super exciting. We could actually say that the estimates put out by sell side today are kind of below par compared to what you've been used to for the last 10 years or so, right? So whereas in other markets it's actually the opposite, right? So you have large parts of EM and Asia, especially North Asia, China, Korea, Taiwan, which are coming out of a bad 2022 and getting into a 2023, which is seeing fairly sharp uplift in earnings, and those markets are probably still not fully priced in. Right, so on a relative context, ignoring the changes, etc., the numbers from India are not super exciting compared to its own history, whereas for other markets they are a lot more exciting and they are cheaper compared to their own history, and they are still expensive compared to our own history. Having said that, we are also still continuing to see earnings cuts, in India. If you actually look at it for 2020. FY24, I ignore FY23. We are in the year right now. You always see big cuts in the year in which you're currently in. Even FY24, we are seeing big cuts. We are getting nearly 35 of the 50 Nifty stocks are seeing earnings cuts over the last 3 months. And finally, I think something which is kind of related to what you guys were just discussing, recently, just before my conversation started, in terms of money from households and HNIs and retail going out. That's been one of the biggest worries for me for the last year or so. India was elevated on valuations because there was a lot of household money that was supporting the markets, because alternative investment or savings alternates were actually not so attractive. But now with deposit rates going up, I think that outflow has started. And of course, there is this short-term issue because of the tax changes that's leading to some outflow. But overall, from a foreign investor's perspective, I think there is still some more correction, underperformance for India to happen. It's definitely a lot better situation than what it was 6 months ago, but probably some more underperformance is warranted, before you can start turning constructive.
Sunil, hi, good morning. Surabhi here. So, that's a sobering thought, and I think the market's been grappling with that. It's not been an easy ride last 15 odd months, right, here in India. But I think the biggest question is what you described. We have been getting these earnings downgrades, but for instance, where do your estimates stand for FY24? The question is, at 18 times or 19 times, has the market fully priced in the earnings deceleration that we're anticipating in FY24?
Yes, so I think I come from the perspective that you will always see earnings cuts. That's how sell side generally works, and hence in that context, I think what we are seeing right now is kind of slightly more than usual. You don't see earnings cuts for 2 years out already today, right? And that's actually started to happen in FY24. I think, yes, I think there is, further downside, I would say. All things normalized, I would expect for FY24 on integer, the EPS integer, probably another 6 to 7% downside. And, once that happens and once the market has absorbed that, I think it's probably a good time, for you to start looking at. So what's really held up the earnings so far was that the banks were, getting really good numbers on, NIM expansion. But I think that cycle is also changing, right? I mean, with the deposit rates going up, the margin opportunity is also closing out, and you should, if not already, you should start seeing, some cuts in the banks as well. And that was one large chunk of the Nifty which was still holding up on earnings.
Sunil, so in the last 1 month, which sectors are likely to, based on the developments in the last 1 month, which sectors are likely to see more downgrades than what you had earlier anticipated? So, for instance, if a month back you were anticipating a 12% kind of growth in IT, now given the turmoil that we've seen in the global banking sector, you're now expecting IT to slow down further, and therefore the IT EPS growth has trimmed down to 9%. So, could you give us a comparison a month ago and what the situation now is sector-wise and EPS expectations?
Yeah, so generally, you're right. A few things have happened globally over the last 12 months, and that basically means that the market's factoring in a higher probability of a recession in the US. And if you recall, UBS economics team, macro team, has been arguing for a recession for a while, but it seems like the market is also coming around towards that view. So if you're domestic facing, looking at India and looking at the Indian economy as a sector, I think you're generally better off than if you're somebody who's exposed to global trade and US economy, etc. So you're right. So I think IT is one place where you want to be a bit skeptical. Commodities, metals. I mean, we are underweight on materials as well. On the flip side, you want to be facing the Indian consumer. You want to be facing either through a financial sector or through consumption sector. So if you actually look at our preference among sectors within India, I think we like banks. I mean, it is one thing to say that it's a consensus trade, but they still have corrected for whatever global reasons. And if you actually think about it, the position of Asian banks in general and Indian banks in particular, I think the health is reasonably good. The regulators in this part of the world are a lot more conservative, and valuations are okay. I mean, in the context of an expensive market, I think banks are still places where you would want to look at. Yeah, we would be a bit cautious on commodities and IT.
Okay, a little bit cautious on commodities and IT. So, Sunil, are you saying that overall what we're seeing with this banking crisis play out in the US, in Europe, you don't see too much of a risk for India? And also, do you think overall, if there is to be a big cut in global markets, how much of an impact do you think that the Indian markets will suffer on the back of that?
Okay, so 2 points, right? So 2 questions over there. On the banks, I think the direct flow through from the liquidity and leverage crisis that's happened or the ALM crisis that's happening in the developed market banks. I think the immediate direct flow through into Indian banks, I don't see it too much. I mean, I think as I said, the regulator is quite conservative and the banks are in decent health, right? But having said that, now the broader economic ramifications of that in the developed world, if there is a recession, the Indian market is looking at the Indian economy, one would conclude that India is generally immune to developed world because it's a much more domestic facing economy. But that's not true for the market. The large listed stocks in the Nifty, I mean, you do have as you mentioned, I mean, IT services companies exposed to the developed world economy. We have commodity stocks, energy stocks, which do depend on global trade and global economic activity. So if you actually think about it counterintuitively, there are many markets in Asia which are less sensitive at an index level in terms of index revenues to US and EU GDP growth rates than India is, right? And hence, I mean, that's one other reason why heading into a recession and given the valuations, India looks a bit vulnerable.
That's an interesting perspective, and take your point, Sunil, that yes, at the index level, we have a fair amount of linkage with a lot of global economies, but I think individual stocks, mid-caps, will find lots of domestic-facing businesses. Finally, you are underweight on India right now. What would make you change that stance? What would you look out for, which perhaps changes the thesis?
Yes, sure. I mean, I think we were actually overweight, less than 15 months ago, right? But it's just that I think valuations got stretched for a reason that we could get our finger on, which is basically the domestic household money that was coming in, right? So there has been underperformance. I think valuations itself can be a reason why we can start turning constructive again. Probably let's say another 10, 12% further underperformance versus rest of emerging markets. I think you can really start looking at constructively again. I mean, the long-term story for India is intact. I think it will still remain one of the fastest growing economies and companies of good quality, etc. But I think it was just a case where we felt that the valuations had got stretched quite a bit, and some of that is corrected, but not fully yet.
Sunil, we'll leave the conversation here for now. Thank you very much for joining in. That's UBS underweight on India in the entire emerging market basket. They believe there are more EPS downgrades in store for India, 6 to 7% of EPS downgrades. But if Indian valuations correct by an additional 10 to 12%, then perhaps it's time to get constructive or relook at India with a positive lens. We will slip into a break on that note. On the other side, we'll talk commodities. We'll invite Manisha Gupta on the show.